Hello friends, today let's discuss about fixed income securities. In particular, how fixed income securities is different from equities and in what instance you will go for fixed income securities investment instead of equities. Welcome to Invest and Grow. Let's get started. All right, just to set some context, let's say if you have invested in equities, all you would hope for is that your money that you are going to invest is going to grow over time, and also if you're lucky, you are going to get some dividend as well. Wherein in fixed income securities, as the name suggests, the main component is that you get a guaranteed periodic fixed income, and thereby you do not have a risk of market risk of whether how good or bad a company is performing. Basically, you are lending your money to a corporation or a government or a municipality, and you are going to get your amount back. For that, you are going to get a periodic interest as an income. So it guarantees a steady stream of income. So that is the main advantage of fixed income over equities. Having said that, let's look into what are the some of the key fixed income securities and what are some of the nuances. All right. So first one is the government bonds. This is one of the safest form of fixed income security investment. The first one is the treasury securities. So let's say you invest in a treasury bond. There are three types of bonds, all duration based. If you are investing for 1, 3, or 5, 10 years, up to 10 years, you will invest in treasury notes. Treasury bonds are the next one is the treasury bonds. It goes from 10 to 30 years. This is a longer tenure bond. And the T bills are for an lesser time frame, under 1 year. So all these treasury bonds are 100% backed by Fed government, meaning whatever the amount that you invest, 100% the amount is going to come back. There is no risk of or a defaulting risk. And basically, you are also going to get the periodic income coupon rate, which is a coupon which is also assured. So, out of the entire lot of the fixed income, government bonds, the treasury bonds are the safest form of investment. The only thing that you wanted to consider is that the coupon rate of treasury bonds would be slightly lesser than the municipal securities or the corporate bonds. Okay, let's look into the other flavor of government bond, municipal bonds. Municipal bonds, again, it is not actually issued by the Fed, but it's issued by the local municipalities. Let's say if you're in a particular state, for example, you live in New York. New York may, as a state, it may have multiple municipalities or the corporation. They would every corporation or the town that you're in would constantly need amount whether to build schools or build library or build the toll roads or whatnot. There would be multiple needs for which it's going to issue the bonds, and as a form of the repayment, the bond is paid after some time, and the periodic coupon is also issued. The only the downside that or the minimal risk is that the municipal the securities is not fully backed for the default, meaning yes, in all means it's going to you're going to get the money back and also the coupon, the frequency. But in case if there is an for various reason, if the project is not going well, there is always a risk of default. In that case, your money is not fully backed by any government, so you take your chance and you invest in muni. In municipalities, municipality bond, there are two things. One is the general obligation and revenue bonds. The revenue bond, as the name suggests, it's issued for a specific need. For the same example that we discussed, whether it's a toll road or building a particular property, it has a revenue stream. It's backed, so it is a guaranteed that the investor are going to get the money back. So it is an extra layer of protection there. That's on the govies. This is okay. The core thing to consider is that all the fixed income securities are rated by top-notch credit agencies. The three credit agencies that you're looking at is S&P, Standards and Poor's, Moody's, and Fitch. So these three credit rating agency rates each of these securities, whether it's the government bonds or a corporate bonds, They evaluate and the project needs and the company balance sheet and all these things, and say that okay, this is the safest form of investment, and they rate like A plus plus, B plus, C, depending upon the quality. So there is definitely a yardstick or something that you can look into to make sure that okay, are you buying in good quality of fixed income securities, and the credit rating agency rating is a great indicator to gauge and as you invest. Okay, so let's now look into the corporate bonds. Corporate bond is the general or the common form of an investment. Now there are many corporations, companies like Google or on Facebook or on Apple. They all the time the companies have the need to raise capital, and for a short-term needs or whatever it is, they issue the fixed income securities, and they also typically the duration varies from companies to companies on the bonds. Let's say if it's a 20-year bond, the same principle as like government bonds. For the 20 years, you're going to get the coupon paid, typically paid twice an year, and towards the end of this the maturity date, you're going to get your amount back. And again, how you would gauge a corporation is a great company. Thereby you can go ahead and invest. It all depends upon the quality of the company. You can also gauge using the credit rating agency rating. That's on the govies and corporate bonds. The next form of fixed income is the CDs, certificate of deposit. So this is for a more super conservative investor. For example, they are paranoid about the market, how the interest rates, or how they wanted their safety or full protection. CDs, as offers a slightly lower interest rate, but much better than the checking account savings, which is in this example 1.5%. It's a decent interest rate. Instead of your cash sitting on a savings account, you invest in CDs and you get this decent returns. The only thing is that it would be locked for a 16 months or a 24 months. You have to go for a typical lockdown period of certain months. So your cash is lent for that certain amount for which you get the guaranteed interest rate. This is a safe form of investment because it is protected by FDIC, as like how your cash is protected in a bank, in a checking account or a saving account is protected by FDIC. CDs are also protected by FDIC, so it is an 100% safer investment. And the last one in the category is the preferred stock. In the equity world, we all the time we say it's stock. In the main catch of preferred stock versus a regular stock is that preferred stock, the investor get a guaranteed dividend. So as it falls into the fixed income bucket, obviously the investor is looking for a periodic income, and this instrument is offered in a way that this preferred stockholders gets the guaranteed income of the dividend. So thereby they have a periodic income stream. So these are the four form of fixed income securities, and there are multiple nuance or the details. There are callable, puttable, the many things, and the derivatives tied to each of these things. But at least the goal of this session is to expose the high level securities, so you make a conscious decision of which one you would want to go. As we kind of wrap this up, let's look into the pros and cons. The obvious pros on fixed income is then steady periodic income. So unlike you invest in equity, you are hoping that simply the company is going to perform well. Here you get a guaranteed income. More on top of it, you get the your money back. The another good news is that this is exempt from the tax, meaning all the fixed income securities, the income that the coupon that you get, all the municipalities is 100% fed as well as state and local tax exempted, wherein in treasuries you are not exempted from the fed, but the state tax is exempted. So that is the good news there. So you get double benefit out of here. That's a key thing. In terms of a disadvantage, it is important to understand the disadvantage, the credit or the default risk. We talked about this one. What if a company, a corporation goes bankrupt? There is always a risk of you are not getting the money back. So that is the default risk. Of course, this default risk is not there at all for treasuries and municipalities. There is a chance of yeah, bond or the municipality which issues going bankrupt or the project fails, thereby you lose the capital. The next one is the interest rate risk. Interest rate, as the interest rate constantly changes over time. Let's say you today you invest in an fixed income security which gives you a 7% returns, and if interest rate is to change and it gets to 10%, obviously you are missing on that premium interest rate. You can always sell your existing one and get into a new one, but always you have to be mindful that the interest rate fluctuates, and thereby you may not in a position to take advantage of the latest one. The next one is the inflation, right? So needless to say, the primary difference between fixed income and equity is that fixed income, you are going to get the exactly the same money back, and all you are going to get the periodic the investment returns in forms of coupon. Wherein let's say you invest 20,000 today, and after the maturity of 20 years from now, you are going to exactly get back the 20,000. Your money, the original investment amount doesn't grow. So you have to be mindful that all you're reliant on the periodic income, not necessarily the amount that you're investing in, wherein the inflation is a greater hedge when you go for an equity. So that is the biggest difference there. So while fixed income has its lot of pros and cons, for anyone who's looking for a steady stream of income and wanted to preserve the capital, fixed income is the right way to go. And it's as like equity, fixed income securities are widely traded, so you can get into any broker dealer and pick any corporate or a treasury or a government bonds, and you can trade and invest. I hope this provides some context on fixed income. If you have any comments, thoughts, please leave your comments. And if you like this video, hit the like button and subscribe to the video, subscribe to the channel. And thanks for watching.